Hey everyone, and welcome back to my channel. So today's content is actually going to be very exciting. So if you've been saving money for maybe a down payment, a wedding, or a dream vacation, and you've been wondering where you should actually put this cash, well, I have a solution for you. Today I'm breaking down GICs, which are guaranteed investment certificates. We will cover what they are. We'll compare how they stack up against savings accounts and whether you should use these for short-term investments or maybe for your long-term goals. So stick around, get a pen, get a paper, let's dive in. Well, you might be wondering what a GIC is, so let me explain. Think of a GIC as a deal you make with your bank or with your credit union. You're essentially saying, hey, I'll give you my money for a specific amount of time, and in return, you promise to give me back my original amount plus an agreed interest. Now, here's how it works. Let's say you have $5,000 or maybe $10,000 or even $1,000. You go to the bank and you buy a 1-year GIC from your bank. During that year, you can't touch that money. That money is locked for 1 year, it's locked in. But at the end of the year, you're going to get back your money back from the bank plus whatever interest that the bank has promised to pay for that period in which you held the money. The key word here is guaranteed. What that means is the amount that you invest, the amount that you save is guaranteed to come back to you, plus the interest. So two things are guaranteed, the principal amount and the interest payments. And this is quite different from stocks, from mutual funds, from ETFs, where the value can go down, can go up or down depending on what the market is doing. But with a GIC, you know exactly what you're going to get. The bank tells you what the interest they'll pay, and the number does not change regardless of market conditions. So there are no surprises, no losses on a GIC. Now, because a GIC is guaranteed, because it's predictable, it makes it perfect for your short-term goals. So if you need a certain amount of money by a certain date, let's say you need to save $40,000 for a down payment at the end of the year or in like 18 months, with a GIC, you can lock that amount with the bank at a guaranteed interest, and your money is safe without any risk of losing value. This then raises a very interesting question that what is the difference between a GIC and a savings account? And the key difference is just flexibility versus the returns. With a savings account, you can access your money at any time, but the flexibility in accessing your money at any time means you can only earn lower interest rates. So the bank will pay you more interest when you commit to leaving your money with them for a longer period of time. Now, with a regular savings account, you might get up to 2% just on a regular savings account, not on a high yield savings account. Regular savings account, you might get up to 2%, which you can withdraw at any point in time. But with a GIC, you might get around 3%, maybe 3.5%, but your money is locked in for that period. So when does this actually make sense? When does it make sense to use a GIC or a savings account? If you have an emergency fund, it's better to keep it in a savings account because you need the flexibility of accessing your emergency fund at any time. Emergencies don't give you a heads up. Emergencies just show up as emergency, But if you're saving for a specific goal, if you're saving for something that's going to come due in a year or 2 years, or maybe in 5 years or 18 months, whatever the timeline may be, and you wouldn't need the money before then a GIC could be your best bet because you're going to lock that money in at a designated and an agreed interest rate. But you only need to be sure that you wouldn't need early access to that money, because breaking a GIC, withdrawing your money before the due date, you're going to incur penalties on it, or you might even lose the interest that you've gained already. Now think about it this way. A savings account is literally like money in your back pocket, but a GIC is money in a time-locked safe where that safe only pops up open at a particular date. Another thing to consider if you're going to go forward with a GIC is that not all GICs are the same. There are different types and there are different nuances to consider with a GIC. Now, the first type we have is a non-redeemable GIC. And these are the traditional types where your money is locked in up until maturity. There's no early access to your money. But with this is you get the best interest rate. And these type of GICs are perfect for those who are certain of their timeline, those who can say, okay, for the next 1 year, I need to lock my money in and I won't worry about it. So if you are that kind of person, a non-redeemable GIC will be the best place to start. The second type is a redeemable GIC or the cashable GICs. These type lets you take your money out after a minimum period, usually between 30 to 90 days. But the downside is you get lower interest. So a redeemable GIC is great when you want flexibility with better rates than what the savings accounts can give to you. Now, the third type is the market-linked GICs, which tie your returns to the stock market performance. However, your principal is protected. But if the market doesn't do well, you might earn little to no interest on your investment. These market-linked GICs are a little bit complex and are usually not ideal for beginners. For most people with short-term savings goals, it's usually best to stick with a straightforward, non-redeemable GIC if you are confident in your timeline, or you can do a redeemable GIC if you want the flexibility. When you buy a GIC, you choose your term, and this is typically from 30 days to 5 years. Longer terms means higher rates. You also get to choose whether you want to take your interest when the term limit matures, or whether you want to receive that interest regularly during the hold period. And here's the important and probably the best part. GICs are protected by deposit insurance, which is the CDIC for banks, and the insurance coverage goes up to 100K for your invested deposits. So know that your money is safe even if the bank fails. Let's do a quick check to find out if GICs are going to be ideal for you. So if you have a specific goal with a specific timeline, let's say you have a down payment on a house that you want to pay for in 2 years, or maybe you have a wedding, or you have a big purchase to make 12 months time, or you have tuition starting in 3 to 5 years, a GIC might be perfect to start with. A GIC is perfect if you know when you need the money, and you also know that you wouldn't need the money before then. GICs are also perfect for people who are risk averse, people who can't stand any form of investment risk, and people who only want guaranteed returns. GIC may not be right for those who want easy access to their money. Let's say you put your money in and tomorrow you want to take it out. GICs are not the best things for you. And it's also not perfect for those who have a long-term savings horizon. Let's say you want to save money for more than 5 years. A GIC doesn't give you that runway because other investments will have better returns than what a GIC will give you in 5 years. And it's also not perfect if you can deal with some risk, which would give you some higher returns. And so the bottom line is GICs are good for one thing and one thing only. They are safe, they are predictable, and they are perfect for risk-averse investors to use for short to medium-term savings. If you made the decision to go ahead with the GIC and you're wondering where to buy from, it's actually quite simple. You can get them from banks, your credit unions, or other financial institutions. Most banks even let you buy GICs online. However, you can also go into a bank branch to buy one for yourself. I'm going to list out a few pro tips on how to buy a GIC. The first is shop around. Different institutions offer different rates. Don't just get locked into a rate by your bank simply because you use that bank. Do yourself a favor and check what rates other banks, other financial institutions are offering on their GICs. Second tip is use your TFSA or RRSP. You can hold GICs in your registered accounts. In your TFSA, your interest is completely tax-free, and in your RRSP, the interest earned on your GICs is on a tax-deferred basis, paid back in retirement. Outside of these accounts, GIC interest is treated as taxable income. So using a TFSA or RRSP makes a huge difference in protecting your interest income from taxes. Now, the third tip is to watch the maturity date of your GICs. Banks often renew your GICs automatically when it matures. So if your term is coming due, you need to pay attention to when your GIC is maturing so that you don't get locked into a new term based on an automatic renewal. So if your term is coming up and you want to withdraw that money, set a reminder to withdraw your GICs on the due date before it gets renewed automatically. Now, using a GIC is not free of mistakes, so these are the common mistakes to avoid with using a GIC. Do not lock up money that you might need. There are penalties to pay for breaking a GIC. Usually those penalties are in the form of lost interest or maybe some cash compensation to the bank for breaking your GICs. Don't forget that there are taxes to pay on the interest earned in the GIC. So if your GIC is not in a TFSA or an RSP or even in a registered account, there are some tax penalties to pay on the interest earned in your GIC. And also consider using shorter terms or spreading your money across multiple GICs with different maturity dates. This is what we call a laddering plan. So you have $5,000 in a 3-month GIC. You can put another $5,000 in a 6 months GIC and another 10,000 in a 1 year GIC. So you just ladder it across the different time frames, and this gives you regular access to portions of your money while still getting good rates at different points in time. So there you have it, guys. GICs are simple, GICs are safe, they are predictable. You commit your money for a set period of time and you earn guaranteed interest and you get it back when the term is up. Simple, straightforward investing. Like I said earlier, these GICs are ideal for those with specific goals and specific timelines. When you know you need a certain amount of money by a certain date and you want to avoid any risk with that money. But on the flip side, because of the guaranteed nature, GICs won't make you rich overnight. They won't give you excessive returns on your investment. Your returns are already known before you even go in. Their job is to protect your money from any risk, from any loss, and to grow it steadily. If you're considering saving some money for something that's coming up in 1 year to 5 years, compare the different rates of the GICs that are available, contact different financial institutions and see what they have available to you, and choose what aligns more with your timeline and what rate is best for that timeline. And also consider using a TFSA or an RRSP to maximize returns and reduce any taxes on the interest earned in your GIC. If this content has helped you understand what GICs are, if this has helped you gain more clarity on how to use GICs in your overall portfolio, hit that like button and subscribe for more practical tips. I make personal finance content tailored to Canadians, and let me know in the comments what your biggest short-term savings are. Thank you so much for watching, and I'll see you on the next one.